Here's something the financial media rarely explains clearly. Inflation isn't just a problem. For homeowners carrying a fixed-rate mortgage, it can actually work in your favor. When you took out a fixed-rate mortgage, you locked in a set dollar amount you owe. That number doesn't change. But over time, inflation erodes the purchasing power of every dollar. So the $150,000 you still owe on your mortgage today is being repaid with dollars that are worth less than the dollars you originally borrowed. In real terms, your debt is quietly shrinking, even if the balance on your statement doesn't show it. This isn't a new concept. After World War II, the United States was carrying federal debt equal to over 100% of its entire GDP. By the 1970s, that number had dropped to around 30%, not because the government aggressively paid it down, but because decades of inflation and economic growth made that old debt smaller relative to everything else. Economists call this inflating away the debt, and many serious analysts believe we are heading into a very similar environment right now. The Federal Reserve has strong incentives to keep interest rates manageable and allow inflation to do the quiet, steady work of reducing debt burden over time. For retirees holding fixed-rate mortgages, this is a genuine financial advantage. But here's what most people miss entirely. That same home price appreciation working in your favor is also creating serious tax exposure that most retirees never see coming, and that's exactly what we need to address. If you're a homeowner approaching retirement or already in it, you've probably heard about the home sale exclusion. Single filers can exclude up to $250,000 of gain from a home sale. Married couples filing jointly can exclude up to $500,000. Most people hear that number, feel relieved, and stop asking questions. That's exactly where the problem starts. What the headline number doesn't tell you is that your taxable gain is not calculated simply by subtracting your original purchase price from your sale price. It's calculated by subtracting your adjusted cost basis, and those are two very different numbers. Your adjusted cost basis can be significantly higher than what you originally paid, depending on the improvements you've made to your home over the years. And in a market where home values have tripled in many parts of the country since the late 1990s, the difference between a correctly calculated basis and an incorrect one can be the difference between owing nothing and owing tens of thousands of dollars in federal tax. Here's the harder truth. The $250,000 exclusion was set in 1997 and has never been adjusted for inflation. Home prices in most U.S. markets have increased 200% to 300% since then. The exclusion that was designed to protect the average homeowner is no longer keeping pace with average home values, especially in major metros, coastal cities, and rapidly growing Sunbelt markets. Calculating your adjusted cost basis correctly before you sell is the single highest value financial activity available to most retirees. And the vast majority never do it. Once you understand that your adjusted cost basis can significantly reduce your taxable gain, the next question becomes what actually qualifies. The IRS draws a clear line between capital improvements and routine maintenance. Capital improvements add value to your home, extend its useful life, or adapt it to a new use. Routine repairs simply keep it in working condition. Only capital improvements add to your adjusted cost basis, and only documented ones count. Here are examples that qualify: adding a room or finishing a basement, installing a new HVAC system, replacing all windows and doors throughout the home, adding a deck or screened porch, installing a swimming pool, replacing the entire roof, adding solar panels, installing new flooring throughout the home, adding a fence, resurfacing the driveway, and major landscaping that permanently improves the property. Here's what does not qualify: repainting walls, replacing a single faucet, routine carpet cleaning, fixing a broken window, patching a roof section, or standard annual maintenance. The financial impact of this distinction is significant. Every dollar of documented capital improvement reduces your taxable gain by $1 at a 15% federal capital gains rate, which applies to most retirees. Every $10,000 in documented improvements saves you $2,500 in federal tax. At $50,000 in improvements, that's $7,500 back in your pocket. Most retirees who have owned their homes for 15, 20, or 30 years have made far more qualifying improvements than they realize. The documentation is often recoverable, the savings are real, and the IRS will honor every dollar you can support with records. One of the most common things I hear from retirees is, "I made a lot of improvements over the years, but I don't have the receipts anymore." That's understandable. Nobody told you to keep a home improvement file when you replaced your roof in 2007 or finished your basement in 2011. Here's the good news. The documentation is often more recoverable than you think. Start with your county or city building permit office. Building permits are public records in most U.S. jurisdictions, and many departments have digitized their records going back 20 years or more. Any permitted project, a room addition, a basement finish, a new deck, a major HVAC installation will show up in those records. The IRS accepts permit records as supporting documentation for cost basis improvements. Next, go through old bank statements and credit card records. Most financial institutions allow you to access statements going back 7 to 10 years online. A large payment to a contractor in a specific month is documentation. Pair it with a permit record and you have a solid file. Search your email inbox for contractor names, project descriptions, and invoice amounts. If you used a contractor more than once, call them directly. Many contractors retain job records for years, particularly for larger projects. Finally, check any old home insurance records. When you increased your coverage after a major renovation, the policy change and appraisal documents often reference the improvements made. Every dollar you document is potentially worth 15 to 20 cents in federal tax savings at standard capital gains rates. An afternoon spent reconstructing your improvement history is one of the highest return activities available to you before a home sale. Most retirees are aware that Medicare has monthly premiums. What most retirees don't know is that those premiums are not fixed. They increase based on your income, and a single home sale can trigger those increases in ways that follow you for 2 full years. The mechanism is called IRMAA, the Income-Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain thresholds in any given year, your Medicare Part B and Part D premiums go up significantly the following year. The critical word there is any. Medicare doesn't distinguish between ongoing income and a one-time event. It looks at your tax return, sees the number, and adjusts your premium accordingly. Here's how the math works in practice. If your normal annual income is $60,000 and you sell your home with a $60,000 taxable gain, your MAGI for that year jumps to $120,000. That crosses Medicare's first income tier. Your Part B premium goes from $185 per month to $259 per month, an extra $880 per year. And because Medicare uses your most recent tax return on file, that elevated premium can follow you for 24 to 28 months from a single sale. For married couples where both spouses are on Medicare, the numbers escalate quickly. At higher IRMAA tiers, a couple can face over $8,000 in additional annual premiums, all triggered by a one-time home sale in a market that was driven by pandemic-era supply constraints, not personal wealth. This is one of the most overlooked retirement financial risks in the country right now, and it is completely manageable with the right planning done in advance. If you've already sold your home and received a Medicare premium increase notice, the situation is not necessarily final. Medicare has a formal process called the Life-Changing Event Appeal, and many retirees who qualify never use it simply because they don't know it exists. If your income in the current year is significantly lower than the year Medicare used to set your premium, you can file an appeal requesting that Medicare use your current year's income instead. Qualifying life-changing events include retirement, reduction in work hours, loss of income-producing property, divorce, and death of a spouse. A home sale followed by a return to normal retirement income can qualify under certain circumstances. The appeal must be filed proactively, with supporting documentation, and within the appropriate window after receiving your premium notice. If approved, your premium can be adjusted back to the standard rate, sometimes within 60 to 90 days. However, the far more powerful strategy is running the IRMAA math before you list your home, not after. If you are within $10,000 to $20,000 of an IRMAA tier boundary, an installment sale is worth serious consideration. An installment sale allows you to spread the taxable gain across multiple tax years by receiving the proceeds in structured payments rather than a lump sum at closing. This keeps your MAGI below the Medicare trigger threshold in any single year, potentially saving a married couple thousands of dollars in premium increases. Installment sales require legal and tax structuring before closing. They cannot be set up retroactively. This is a decision that belongs in the planning stage. Before you list, not after you sign. If you have a home equity line of credit or home equity loan and you've been deducting all of the interest since 2018, there is a significant chance your deduction has been calculated incorrectly and you may not know it yet. Before 2018, the rules were straightforward. Interest on a HELOC was deductible on up to $100,000 of balance, regardless of what you used the money for. You could draw on your home equity to consolidate debt, fund a grandchild's education, cover medical expenses, or take a vacation, and the interest remained fully deductible. That changed with the Tax Cuts and Jobs Act. Starting in 2018, HELOC interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. If you used any portion of your HELOC for any other purpose, the interest attributable to that portion is not deductible, regardless of what your bank calls the product or how the statement reads. The IRS applies what are called tracing rules. Each draw is evaluated separately based on how the funds were actually used. A draw that funded a kitchen remodel is deductible. A draw that funded a family loan or living expenses is not. Most retirees who have had a HELOC open for several years have used it for a mix of purposes, which means the deductible percentage is almost never 100%. If you've been claiming full deductibility since 2018, reviewing your draw history now, before a home sale triggers a broader review of your return, is strongly advisable. Proactively correcting an overclaim is significantly less costly than responding to an IRS notice. The decisions that protect the most money in a home sale are not made at the closing table. They are made weeks or months before you ever list the property. Here is a practical 7-day framework every retiree should work through before making any decisions about their home. Day 1. Locate your original closing disclosure or HUD-1 settlement statement and write down your original purchase price. Start a list of every capital improvement you can remember, dates, amounts, and what the work involved. Don't aim for perfection. Start the list. Day 2. Reconstruct documentation. Pull bank statements, search old emails, contact former contractors, and call your county permit office. Building permit records are public and often go back 20 years. Day 3. Calculate your estimated taxable gain. Subtract your adjusted cost basis from your current estimated home value, then apply your exclusion. Write down what remains. That is your exposure number. Day 4. Run the IRMAA calculation. Add your estimated taxable gain to your expected annual income. Check Medicare's current income tier thresholds at medicare.gov. If you're near a tier boundary, calculate the premium impact for both spouses across 2 years. Day 5. Review your HELOC history since 2018. Categorize every significant draw into qualifying home improvements versus all other uses. Calculate the deductible percentage of your annual interest. Day 6. Confirm you meet the 2 of 5 year primary residence requirement for the exclusion. Count your months carefully if you've spent significant time at another property or care facility. Day 7. Sit down with a qualified tax professional, an enrolled agent or CPA, before you list. 1 hour of professional review at this stage is worth more than any conversation you'll have after closing.